with that, let me welcome our guest on the show today, and that is Aamar Singh, the Senior Vice President of Research at Angel One. And Aamar, thanks so much for joining us today. Markets have reached a new all-time high. So give us a broader sense of what you are picturing over here going ahead. This momentum or this rally likely to sustain going ahead, and also what do you think will be the participation of the SMIDs or the small and the mid caps when it comes to this market rally?
Yeah, I would say, first of all, good evening and thank you for having me on the show. So looking at the rally, if you look at today's move, it's been primarily the banks and they're also the heavyweights, HDFC Bank, because what we saw was that HDFC was one, I would say, stock which having the highest weightage in Nifty wasn't really performing, and the stock corrected from almost 1700 levels to 1400 below levels. So we were expecting a pullback, and that's what has actually happened. And that's what really supported the markets. And the good part is that we are seeing that across the board, even ICICI Bank has been performing well over the last few trading sessions. So if you look at ICICI Bank, again, it has got significant weightage in the index. And it needs to clear the 1050, 1060 mark. So that's one level to watch out for. Looking at the other heavyweights in terms of Reliance, if I look at Reliance, how Reliance has been performing, so Reliance seems to be somewhat consolidating at the current levels, but the long-term trajectory for Reliance also continues to remain strong and firm. So overall, the markets have been positive. Short-term, we were seeing some sort of consolidation, choppiness, and I would say some concerns with regard to not rate cuts happening in the US or in India in the near future. So these were something which the markets have really discounted. And also, if you look at India VIX, that is also within very acceptable limits. So that is something, again, of a cheer, because it has moved to 16, but that's acceptable. Sustaining above 18, 20, then that could be some cause of concern. So overall, the broader breadth of the market remains strong and positive. Talking about specifically about mid cap, small cap, there one needs to be slightly on the cautious side, because there we see a lot of volatility and stocks correcting over the few, I would say, few days and couple of weeks, anywhere between 20, 30%, 40%. Also, that sort of correction we've seen in some of the stocks. So you need to be cautious in that area.
All right, Aamar, but what's your stock-specific ideas then? Which are the stocks that you would recommend a trade on?
Yeah, so the first one to look at is from the pharma space, and that is Alembic Pharmaceuticals. So this is one stock which has been in an upward trajectory, but it is still yet to breach its all-time highs. So if we go back in time, the stock used to trade in 2020, it had made a high of almost 1150 levels. Currently, it's around 1050, and we've seen some significant volumes and delivery quantity happening in the stock in the I would say second week of January. Post that, the stock went into consolidation. Today, again, we are seeing some decent volumes and a breakout over those levels. So this is one stock one can look at current levels around 1040 levels, with a target of 1145 on the upside and a stop loss of 970. And the second stock to look at is from the realty space, and that is Suntech. So again, Suntech, if I look at Suntech, it has been consolidating for many weeks. It is trying to break out of a consolidation zone. So and also volumes have been better today. So, but the stock needs to sustain over the 490, 500 zone, because that's a level to watch out for. If we see a breach above that level, then that could be a good entry for the stock, and the stock could witness around 10 to 12% rally from the current levels. So this is the second stock that one can look at from the realty space.
Right, Alembic Pharma and Suntech Realty on Aamar's radar. Aamar, thanks so much for joining us. With that, we'll let you go.